So the TBI Global Targeted Yield Fund is a very conservative investment vehicle. The fund focus is to invest in sovereign paper, in other words, bills and bonds issued by developed market governments, the US, Germany, the UK, and the like, but also the fund is able to invest in global banks and regulated financial institutions. Investment criteria is extremely strict. We manage this as a very conservative investment vehicle. It will only invest in investment grade paper, highly liquid investment grade paper, making this fund an ideal investment vehicle for an investor who's got a very short time horizon on his investment itself and require high form of liquidity. The fund was designed around a specific need of one of our clients who required a high quality liquid investment that is globally diversified. The client specifically didn't want any hard currency exposure. Needs to be only the whole fund had to be hedged into rand, and the design itself focused on that. But standing back, we realized that the need from the client isn't unique. The South African market sits with a very small, limited universe of assets to invest in. And large institutional investors who require a diversified investment pot need to start looking offshore in a hedged format. So we created the fund. The fund is inward listed on the JSE, making it extremely accessible to corporate and individual investors, trust and the like. And the fund will also pay its return in the form of dividends. So dividend distribution on a monthly basis, extremely low volatility, and we expect the net asset value of the fund to pull back to the original 101 Rand listing price on a monthly basis. When you look at the fund composition, the fund's got two very simple rules. Firstly, the fund will invest in fixed income assets that receive a fixed interest rate given that the instrument is shorter than a year. So very similar to what money market funds does in our domestic space. The requirement itself will then force this fund to have very little volatility in asset repricing because the duration is so short. Secondly, if the fund do invest in floating rate notes, in other words, an investment with an interest rate that reset every 3 months. So it is as if you're investing in a 3-month investment. Those notes are not allowed to be longer than 3 years. So once again, the potential for this asset to reprice in any substantial manner is extremely small. Whereas if you buy into, as an example, a bond fund with a long duration, a bond that matures in 10 years, if interest rates shoot up from 9 to 11%, there could be a potential substantial capital loss. In a fund like this, and the composition rules that we have in place, the risk for drawdowns is negligible. So the rand-hedged distributing share class listed on the JSE was specifically designed for a client who wants to invest in offshore assets, but who do not want the currency volatility between the rand and the US dollar, which is the fund's base currency. So that risk is eliminated, and the listing of the asset will enable the domestic investor to receive a dividend, which is very attractive from a tax perspective. The fund's expected return profile will follow the interest rate cycle of developed markets. The South African interest rate cycle is highly correlated to developed markets because of the interaction between the monetary policy being applied offshore and domestically. So the interest rate, the return profile will follow the interest rate cycle. The level of return, we expect the fund to achieve the benchmark of SOFR plus 2%. So that's the secured overnight funding rate in the US. It's published by the New York Fed, which will yield a return similar or slightly above what cash plus funds in the South African environment achieve. So when we looked at the fund's composition and risk profile, the need from the client itself was a low volatility investment vehicle. If we look at domestic money market funds, the NAV of the money market fund is R1. That doesn't change on a daily basis, although the interest rate yield of the fund might fluctuate somewhat. The way the offshore space works, this is not a money market fund, it's a NAV fund. So whatever interest the fund received from its offshore investments will flow into the NAV, meaning that on day one the NAV is 100 Rand. As interest flows into the fund, that 100 Rand will increase in small increments over the month. At month end, we will distribute whatever the fund accumulated in the NAV over that period, and the NAV will move back to its original level. So creating a very low risk, conservative type of investment vehicle that the volatility would be negligible.